Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Priya Misra of JPMorgan writing a print of 150 or higher, and the Fed will likely cut 25 in November. Payrolls around 100K or below means 50 basis points. Bad news on jobs, bad news for risk assets, and the curve should bull steepen. Priya's with us around the table. Priya, good morning.
Morning.
It's good to see you. I've got one question in the bond market, and then we can go broader and we can talk about payrolls. Why is so much money, so much cash going into money market funds right now?
Great question. As we hit another record yesterday, I would say one word: valuations. You know, the fact that you're still getting 4.5% to 5% on money funds, the yield curve is still inverted. Every asset class is priced for a soft landing. So I think people are staying in cash, waiting for better levels on bonds, better levels on stocks. I will say we're seeing significant inflows into bond funds, but people are waiting for, well, I'll buy when the 10-year treasury is at 5%. You're not getting that. You know, inflation's coming down. The Fed's telling you they're going to cut. We don't have to read between the lines on the Fed put. They're telling you it's there. If things weaken, they're going to cut much faster. And I think people who've been sort of, you know, there might be a melt-up move, because if you get a short period of volatility, we are absolutely going to be in there buying if there is a risk off. But I think, you know, there's a sense of everything is so well priced, everything's done well. Let me just stay in cash. It's still giving me 4.5%. Well, within a year, it's going to give you 2.5% or 3%. And, you know, that's when I think a lot of that money is going to start to move out.
Although it comes at a time when people are taking a look at what's going on with the oil prices. They're taking a look at what's going on with the resilience and a number of different indicators. Yesterday, we had ISM services data that came in better than anyone expected, who was surveyed by Bloomberg. And you have to wonder whether people are questioning this idea that the Fed is willing to go 50 basis points so quickly. You heard a slew of people lining up, 25, 25, 25. And then Neil Dutta saying, no way, stop it, guys. How much do you see this as sort of a given, even though you are seeing signs of strength in so many places?
So I think the data is really mixed. You can see signs of strength, then you can see signs of weakening. Look at that unemployment rate increase. Look at labor differential in consumer confidence. I think this is where the earnings report, details of the job report. You've been talking about revisions. I think revisions, look at dispersion within jobs. Is it really only 2 or 3 sectors that is creating all the job growth? What happens with margins? So I think there is, you know, a lot of uncertainty. The data is not giving us a clear picture, and every market's priced for soft landing. So I think this is where I would push back. Re-acceleration risk seems to be off the table. I think we've got really a bimodal world. You've got these binary risks, and there's a lot between the election, between geopolitical risk, between payrolls, frankly, or the entire jobs report. We're either stay in soft landing, everything is priced in, but can rates fall some more? Sure. Can spreads tighten? Absolutely, if we stay in soft landing. Or we go much worse. And I think that's the world that we're sort of grappling with.
And that's the reason why you think good news is good news for risk assets, because ultimately you do think that reacceleration is off the table. I want to pick up on that. Are you basically saying that this head fake that we're seeing in oil prices is a head fake, and that any kind of tick up in yields is a buying opportunity right now, because ultimately inflation is dead?
I think so. I mean, oil price increase through supply-related issues, which is what this is, that's actually a tax on consumers. So I think if it's geopolitical related, I would not buy it. If there's massive fiscal easing in China or significant fiscal easing in the US, which actually creates growth, then it's a different question. But I think oil prices is negative. Bonds are a diversifier for risk assets. We saw it the last 2 payroll reports. We had slightly weaker numbers. You got, you know, the market pricing in this higher chance of 50. Rates fell. And that's why I think, you know, if you get weak numbers, we're going to price in 50. And the whole idea of why did the Fed go 50? All those reasons are still, you know, present today. Monetary policy is restrictive. What's 150 basis points really going to do? I think, friends. Well, exactly. I think for the housing market, you need mortgage rates much lower. We're talking 4%, 4.5%. We're not, you know, at 6%, you're not going to have that happen. You're not going to create a big positive on the housing market. So when I think about re-acceleration, I look at where are the drivers. It's not rates. You need much lower rates. It's not really fiscal so far. This is where this is where China becomes important. So right now, I would say oil prices, and that's resulted in this rise in rates, it's absolutely a buying opportunity. If you've got risk on your portfolio anyway, and we do, we get a little nervous about all these binary risks. I think owning some hedges, be it steepeners, owning some duration, especially given this backup, it's an opportunity.
Priya, let's talk about the election. You went there. You say after the jobs report, the market's going to be solely focused on the U.S. election, and you say the market will move in any scenario since it is not priced for any scenario. But if you have conviction that you think Harris is going to win with a sweep or Trump is going to win with a sweep, how should you be pricing that?
It's very hard. I would say your key point was the sweep. I think what happens if it's not a sweep? But I love that you bring up sweep because I think everyone focuses on the White House, not y'all. I know y'all have talked about Congress. Congress is very, very important. So what happens with the House? And this is where the House is at a knife edge. The presidency, look at polls. I'm not even sure we can trust polls a whole lot, but the polls are very close. So, and then look at all the policies we're talking about, right from tariffs, which actually doesn't need Congress as much. Fiscal policy absolutely needs Congress. Immigration, regulation. There is so much out there that we're going to have to see, what's the make. Will we know the result on election night? I hope for all our sakes that we do. But what if we don't know that? What if it's a divided government? Then we have to see what is priority number one. And there's something on the campaign trail, and then there's actually what they talk about. So I think for the market pricing, we're going to move in either direction because there's so many unknowns around the makeup of Congress, around the presidency, and then what policies are their number one priority.
And what happens when the FOMC meets and we don't potentially have an election result?
I think they look at financial conditions and the economy, clearly. If monetary policy is still restrictive, which is likely to be, we're going to be in the four handle. We can debate R-star and say maybe neutral rate is not 2.5, but 3.5. It's not 4.5 or 5. So I think they continue to cut. They're going to try and be as apolitical as they can. Look at the data, the entirety of the data, inflation and growth. I think Governor Waller tells us inflation is also important. So we have to look at both. And then look at financial conditions. In the scenario where we don't have an election result, financial conditions will tighten. Because markets don't like uncertainty. You don't want binary outcomes which you don't know how to price. In that scenario, I think they cut and they tell us, well, if financial conditions continue to tighten, we'll cut more. I think that's the message we'll want to hear.
So final message from you. I'm sitting in cash like so many other people. What do I do? Where do I go?
I think you buy bonds.
Okay.
I don't want to talk my book, but I think...
Well, I had a feeling you might turn around and say it might be the Core Plus bond ETF.
If you're getting, investment grade, securitized, high yield bonds, high quality, I think high quality fixed income is sort of the best place to be in right now. Spreads are tight, but look at all-in yields. You're getting 5.5% higher than money market rates. So if you're in money funds, you're getting 4.5, or you get 5.5. And it's going to be a diversifier, especially if one of these events, when we talk about October surprise, we have multiple contenders for the October surprise. If any of them pan out, you've got that yield and you've got that hedge.
It's a massive month ahead. Priya, it's good to see you. As always, thank you. Priya Misra there of JPMorgan. Let's get to the market view. Jeff Rosenberg of BlackRock with us. Mohamed, El-Erian of Queen's College, Cambridge with us as well. Jeff, I want to come to you first. Your thoughts on this, and as a market participant, what do I do with this?
Yeah, clearly, as was just described, this is, across the board, a very strong report. If you look in the under components, retail, professional services, education and health services, all significantly beat above their 3-month running average. And, across the earnings and the household survey, this is a very strong report. As was mentioned before, the revisions in terms of August was kind of expected. The home-based data and the alternative data, you had some people looking at that as well. Maybe not to the extent, Bloomberg and Anna Long did and emphasizing it, but you certainly saw, some data points that were pointing towards, the potential here for a stronger report. But this is stronger than anyone expected. And as Lisa said, and I think this will be the longer run debate, and it's something we've talked about on this program a lot, the debate about not only where kind of policy is, how restrictive it really is, where, R* and neutral stands, but something else that has really been missing from this Fed's conversation that was present in past cycles. They've abandoned it, and that is the impact of financial conditions. Financial conditions say that this is a much easier monetary policy, and you look at where growth is, and it's kind of it's a concurrent signal, but growth is running well above potential, and that really tells you that this is not as tight of a Fed as the market, or really as the Fed thinks it is. Today is maybe another data point kind of in support of that view.
Mark Rowan, Apollo, earlier this week, financing is available, real estate prices are going up, it's not clear we need more rate cuts. To the extent we accelerate the economy and have to go in the other direction, that would not be a good day. Mohamed, I want your early views on this jobs report, and what on earth does the Fed do with this one?
So thanks, John. 4 takeaways, including for the Fed. One, on the labor market. This is not just a solid labor market, but if you take these numbers at face value, it's a strong labor market late in the cycle. 2, for the economy, it speaks to U.S. economic exceptionalism, something we've seen and something that's continuing. 3, for the Fed, it means pushback much harder against pressure from the markets to put you in the single mandate box. Enough talk about inflation is dead. Inflation is not dead. Enough talk about the Fed should only be concerned about maximum employment. It should still be concerned about its dual mandate. And finally, for the markets, I think this is pushing back against what has been, in my view, and you've heard me say it over and over again, an overly aggressive expectation of rate cuts by the Fed. I think this will get the market closer to what's likely. And then we're going to have a debate on 2 things. One is, where's the neutral rate? And 2 is, how do you think about this economy in terms of growth and employment, and how are these 2 things coming together? So, at face value, this is a report that will cause a lot of revision, both in analysis and in market pricing. But I stress it is part of a much bigger picture of mixed data. And that's where the complications arise, John, as you know.
Mohamed, Emery nailed it when she started saying, how much does this have to do with the 50 basis point rate cut? And it's somewhat tongue-in-cheek, of course, but at the same time, there is a real question. How much have the easier financial conditions that have basically been manufactured by this Federal Reserve helped boost a market that wasn't maybe in need of such a big boost?
Look, you know my view. We've been living in a world of liquidity dominance. It has been all about liquidity. That world was reinforced by a 50 basis points cut. Let's also remember that the market didn't expect a 50 basis point cut based on data. It expected it based on a reporting on the Thursday before the Fed board meeting. So there was no economic conditions that would justify 50 basis points, but there was a leak to a newspaper that moved market expectations. I worry that we continue to feed this monster of liquidity dominance, and at some point we may regret it, either because inflation will not settle at 2% and or because financial instability will result from excessive risk-taking.
Mohamed, is there a chance that we can have a no landing scenario?
Sure, there's a chance that we can have a world in which there are positive things happening on the supply side, and we can be, quote, bigger but not hotter. Yes, that is part of the distribution of potential outcome. I think a soft landing is still the 55% probability. Bigger but not hotter is 15%. So add them two up, you get 70, and then you have a 30% probability that either because of or because of weakness in low-income households or because of a Fed policy mistake, we end up in a recession.
Looking at these numbers, and Mohamed, thanks for being with us. You're going to stick with us. If you are just joining us, welcome. It's about 8:45 Eastern Time this morning here in New York, and about 15 minutes ago, we got a blowout jobs report, 254,000. The median estimate in our survey was 150. Lisa's talked about the revisions repeatedly. The revisions were good. They were positive. If you look at the unemployment rate, we've dropped back to 4.1% from 4.2. Mike McKee suggesting we came very, very close to dropping to 4.0. Wage growth was hot as well. A lot of this was very unexpected. We've said it repeatedly through this morning. The range of estimates stretching from anywhere between 70 at the low side and 220 at the high end. Nowhere near this one. I want to throw this one at you. There will be a lot of people in this country that don't believe these numbers. They will look at them, and some will say sarcastically, snarkily, they will say, if you're the Harris campaign, you couldn't have written this jobs report any better even if you wanted to. There are others who look at this, perhaps a little bit more sophisticatedly, and say that even the chairman himself is mentally marking these numbers down by, let's say, 50 or 60,000. Should we be doing the same thing this morning?
I think that's fair. And if it was a weak report, that would have been the initial thing of, okay, well, now if you subtract out the 68,000 that we got from annual revisions last year, now we're in trouble. The initial reaction to this jobs print isn't necessarily that, but it should be. So perhaps the conclusion shouldn't be the economy's on fire or there's no landing. It's probably that we're actually hitting the soft landing. If you take a straight 3-month average, you're at a little above 186,000. Then if you subtract the QCEW, then you're at a trend that's kind of normal. So I think the market reaction is probably going to be a bit extreme on the back of this. We should probably look through it. Last night the concern was we're headed for a recession. Now the concern is no landing. It's probably somewhere in between.
Jeff Rosenberg is good news. Good news.
Good news is good news here. And I think the key, going back to what Mohamed said, is the market had been very aggressive in terms of its pricing for the Fed. Partly maybe that pushed them into the 50. You had more than 225s for the November and December priced in. That's obviously pricing out here. And, next week when we get the CPI number, you may have, as Mohamed was suggesting, more of a debate as opposed to a one-sided debate where we shifted completely away from inflation as the focus back to growth. Having a little bit more balance here is going to make the outlook a little bit more challenging. And I think for the bond market, it's going to have to reassess its pricing in terms of how aggressive it has been pricing, as Mohamed pointed out. Very aggressive from the get-go here in terms of expecting, the most extreme in terms of what the Fed was going to be able to deliver. Hard to say whether next week you get that surprise. I don't think we're talking about here inflation going back up and an inflation scare. That's not the point. The point about no landing is that the last mile from 2.6% inflation down to 2% may be harder to achieve. And why it's harder to achieve is because growth and financial conditions are not as tight as the nominal rate suggests. And so you don't have to necessarily be as aggressive on securing the soft landing because the inflation side is pushing back. That's what you're seeing here this morning in terms of pricing. It makes the front end here a bit more rational in terms of pricing in less than 250s to the end of the year. And I think that's starting to be more of the story pricing out of the bond market.
Jeff, how offsides is this market? And we saw this being sort of sniffed out earlier this week, this idea that people were thinking, wait a second, maybe we overplayed just how many rate cuts there would be, just what kind of dollar weakness there would be. How much does that trade, the steepening curve, all have to unwind as people reassess with this data?
Yeah, and as you pointed out, it started earlier this week. You've had some better data. The labor market data hasn't been as one-sided in terms of the fears, in terms of negativity. There's still a preponderance of the steepener view because when you're in a Fed cutting cycle, and we're in the beginning of the Fed cutting cycle, it's about how fast and how front-loaded it's going to be. It's also about the terminal rate and where it ends up. But generally, when you're in that time period, the steepener market reaction is what you're going to get, and you're starting from a very flat point of the curve. The problem for the steepener trade is timing. You need the pace of steepening to overcome the negative cost of carry, and fast levered players don't have a lot of patience for that negative carry, and so that can, as we're potentially seeing this morning, kind of exacerbate the moves on the headline. Going back to the birth-death model and what Bloomberg Economics has been highlighting, yes, this may be overstated in terms of the headline impact, and therefore may be overstated in terms of the impact of the market move. But the overall message here is that this is still a normalizing labor market, but not necessarily normalizing to the point where the Fed has to deliver consistent 50s to secure that soft landing.
Mohamed, one thing that you've talked about is that this is an overly data-dependent and data point-dependent Federal Reserve. It seems like everyone expects this Fed to still cut at least 25 basis points. Do you think that they have moved to a framework that is less data-dependent if the data actually suggests that the labor market is doing just fine?
Yes, I think they're moving that way. It started with Chairman Powell's Jackson Hole speech. It continued in his press conference. And I think they are moving away from being overly data dependent to also trying to have a forward-looking view of where the economy is going to settle.
Mohamed, does next week's CPI report matter to you at all now?
It matters to me, Anne-Marie, and the one that's going to matter even more is the one after that. Yes, it does matter to me. I think Jeff is absolutely right. This notion that the last mile was going to be easy, this notion that inflation is dead, this notion that we are mission accomplished, came way too early. And I think we're going to see from core inflation why certain parts remain sticky. Meanwhile, headline inflation is going to start moving up after not this month, but the next month. So yes, these CPI prints still matter. And of course, they matter a great deal to the American people.
Mohamed, talk to me about what kind of numbers you think we have to get accustomed with. Are we talking about stabilizing at these levels for inflation, or are we talking about the real risk of reacceleration, given what's happening in the commodity market, what we've seen out of China, and the easing that's come from the Federal Reserve, that after a jobs report like this, some people are thinking has come prematurely? How real is that reacceleration risk for inflation?
So to the extent we have an equilibrium rate of inflation, for today's economy, it would be 2.5% to 3%. If the Fed had the option, which it does not, if the Fed had the option to set a new inflation target, that is where it would make sense. We will settle, I suspect, somewhere towards the upper end of that because, as Jeff said, financial conditions are extremely loose. There are two factories of credit, two factors of liquidity. You heard it in the interview with Mark Rowan. There is not just the official factory, which has produced a ton of this, but there's the private factory that's getting more and more efficient and producing more and more credit and leverage and looser conditions. And we are living in a world where these two factories are still operating at quite a high level. So there is a risk, John, that we will settle towards the higher end of that 2.5% to 3%.
Stephanie, I'm struck by the fact that given this report, we've all been thinking about organized labor working on the dock worker strike with the Boeing strike as being sort of at the end of labor having the leverage. Is that a wrong way to look at this, especially given the fact that wages went up? Is it actually that employees have still the upper hand when it comes to demanding work and demanding to be paid?
I don't think that's an entirely fair way to look at it, in the sense that if you look at ECI for union versus non-union workers, there's a clear lag from union to from non-union to union, in that you get a big acceleration in non-union wages and then unions tend to follow. I think this is really just a catch-up, but a catch-up from a really big acceleration in wages. So this is kind of a lagging indicator. The wage number, yes, it was 0.4, but it was, if you look at the three digits, it was 0.369. So yeah, it was strong, but it, you know, if you look at an average pace, you're still running a little bit below 4%, in which case it's not really concerning.
Final question for you all, and I'm going to say it up front so you all don't have to, and you can answer with just one word. There's a lot that can still change in the next month, but as things stand, your best guess for November 7th for this Federal Reserve, and these are the choices: 50, 25, or no cut at all. First to you, Jeff Rosenberg.
I'm going to go with 25, Jonathan.
Mohamed?
25.
Stephanie?
25.
Let's see how much changes in the next month or so.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.